What's going on, everybody? It's Blandon here again for Mortgage HQ. So you've built up quite a bit of equity in your property portfolio and you go back to the bank. Unfortunately, they keep telling you that you can't borrow more because you can't service the loan. There's an actual term for this. It's called asset rich, cash poor. So in this video, I'm going to show you exactly how you can create infinite borrowing capacity so that the bank will keep funding the growth of your portfolio. I'm going to review to you the most important ratio that you need to aim for in your portfolio so that you can never run out of servicing capacity. Now, I didn't believe that this could happen either until I saw a client actually execute it. So to give you a bit of a background story, young Dan actually have 6 investment properties and he wanted to buy his 7th investment property. But unfortunately, even though he has a ton of equity and pretty good rental income, the bank is only willing to lend him another $200,000. Now, it just wasn't worth his time because his portfolio was pretty substantial already, and a $200,000 investment property in the regions didn't really excite him and he felt stuck. So instead, what we looked at was what kind of improvement he could make on his portfolio. And we found out that this property here, we could actually build 4 more houses on it. And because he's getting 4 more rental income, the bank is willing to lend him $1.2 million. This is why. Now, the income received from the first property in proportion to the mortgage that he is taking out is 6%. Now, because we're funding this 100%, this is what we call 6% gross yield. Mortgage HQ likes to call that 6% mortgage coverage. In this situation, however, he's got 4 more property and 4 more rental income. The income to debt percentage is 10.5%. So to understand how this happened, we need to first understand the servicing calculation and smash that like button. We're going to change up the whiteboard again. So there are 3 major components in the servicing calculation. This is the same across all banks. There is income, expenses, and finally UMI, otherwise known as uncommitted monthly income. This is the leftover from your income minus your expense used to service a mortgage. Now, each of these 3 categories, we're going to break them down into 2 categories. With income, there are 2 major components. Number 1, your net income after tax from your business or your PAYE job. The second major category for income is rental income. The important thing to note here is that rental income gets shaded by 20 to 25%. So even though you might get $1,000 rent, the bank will only use $750 to $800 of that income. Now, secondly, you've got living expense. This is usually an average number that the bank sets depending on how many people are in your family. And other things that gets added on top are childcare expenses, tithing, and also any regular subscriptions that you might have. The second major expense, which is where people get confused the most, is the debt servicing expense. The bank will stress test any mortgages that you have. Even though you might be paying a lower interest rate, they will stress test it at a higher interest rate at principal and interest. So even though you might have a cash flow positive property that is making you money on a monthly basis, the bank is still going to use a higher interest rate when they calculate how much you can borrow, typically at around that 6-ish%. Not only do they use a higher interest rate, they will put it on P&I, which is principal and interest repayments. Now, lastly, you have UMI. So now that you do your whole calculation, you've done all those numbers, depending what you're buying, the bank will use a slightly different term. Now, let's say it's an own-occupied. They will use a 6% interest rate and the principal and interest to stress test your situation, and they'll use a 30-year loan term. Now, for investment properties, they'll use the 6% and the principal and interest, as well as a 25-year loan term, which again, it means that for a property that you're trying to buy, even though it has got a very high cash flow, with the rental income shaded, the interest rate higher, the repayments on principal and interest, and the loan term shortened to 25 years very quickly, you need a very high cash flow property for it to be self-sufficient. So after we take everything into account, and the gross yield that you need to aim for is around 10.5%. So back to our initial question, how can we create infinite borrowing power so that we can keep getting the funding for our growth? Knowing that this is the infinite mortgage coverage you need to aim for, there are two logical actions that you can take. Number one is that you sell down enough assets so that the remaining income in proportion to the mortgage is at around that 10.5% mark. Second thing that you can do is go find deals that are at 10.5% return. But here's the truth. None of you really want to do this because number one, you don't want to sell anything because you're afraid of losing your capital gains. And number two, it is almost impossible to find deals that have around 10.5% cash flow. But there are other solutions. So if this resonates with you, then the case studies in our free masterclass is perfect for you. I have multiple clients that have achieved infinite borrowing capacity, and I'm going to be pulling back the curtains to show you exactly what you should be focusing on in your portfolio so that you can transition your portfolio to service itself without you having to sacrifice any of the capital gains. So check this free online masterclass out. See you there.